Hello and welcome to the Killik and Co market update. The biggest data point this week has been US inflation. We're all waiting to see if the Federal Reserve will cut interest rates when it meets next week, and inflation is a key determinant of that. There was quite a drop in the headline rate of inflation, down to 2.5% from 2.9%, which was good to see because it had been stuck around that 3% level for a year or so, as you can see on this 5-year chart here. We can break down the inflation data into a bit more detail. While the headline rate was 2.5%, food inflation was a bit lower at 2.1%, and energy actually made a negative contribution at -4%. This negative energy contribution will have been caused largely by the fall in the price of US oil. Here it is over the last 5 years, trending steadily lower since 2022. The US actually chose to top up its strategic oil reserve this week, which is likely due to that lower price. All of this will feed into the Fed's next interest rate decision, which is due to be published on Wednesday next week, and at the moment the market is pricing in a 25 basis point reduction. One of the data points we keep an eye on is market breadth, which measures the number of stocks rising in comparison to the number of stocks falling. A number of the major indices these days are market capitalization weighted, and this means that bigger companies are given a bigger weighting in the index. And the S&P 500 is quite an extreme example of this, with the top 10 companies making up nearly 35% of the index and the other 490 making up the other 65%. Here are the current top 10. This means that you could have a situation in which the S&P 500 has gone up, but actually when you look at the detail, 50 stocks, including the biggest ones, may have gone up, but the other 450 stocks may have dropped, so market breadth in that case would not be very good. We can get a sense of this by comparing the S&P 500 index to the S&P 500 equal weighted index. The equal weighted index contains the same 500 stocks, but it gives them all an equal weight in the index. This chart compares the two over the last year, with the original index in pink and the equal weighted index in green. The original index is ahead of the equal weighted index over this time period, suggesting that the strength in some of those bigger stocks has been driving the index higher. The so-called Magnificent Seven are all in the top 10. However, if we look at the same chart over the last quarter, the equal weighted index is ahead, suggesting there is demand for stocks outside of the Magnificent Seven, and therefore that market breadth is improving. And finally, the UK will be using September's data to determine the next increase in the state pension. The new state pension is currently £11,502 per year, and it will be increased based on the triple lock. So that means it will be increased by whichever is higher out of 2.5%, the rate of inflation, and the rate of UK wage growth. The latest UK wage growth figure was published this week, and it was 4%. The inflation figure hasn't come out yet, but the last one was 2.2%, so it's very unlikely that the next one will be above 4%, and therefore we can assume that the state pension will be increased by 4%, and the new government has already stated its commitment to the triple lock. This chart here shows how the so-called new state pension has increased over the last 8 years since it was first introduced in 2016. Moving on to have a look at next week, it's looking very quiet on the calendar, and there are no companies on the Killik & Co covered list scheduled to report, so the main focus of next week will be the Federal Reserve's interest rate decision. Have a great weekend, and we look forward to seeing you next Friday.